Hey there, welcome to the Management Accounting Mastery Program by Genius Up. And in this lesson, we'll be chatting about cost and cost behavior. So, in the previous lesson, we basically spoke about the introduction to cost, right? And the different types of costs that we have. However, in this video, we're going to be speaking about why cost behavior matters, because different costs behave in different ways. And we're going to basically chat about what is cost behavior and what are the main cost behaviors that we have to know and why this is foundational in management accounting. So firstly, why are we studying cost behavior? So managers usually make decisions based on cost, and we emphasized this in the previous video that we really need to understand cost for us to be able to make better decisions. But the issue is cost don't all behave the same. That's the issue. Not all costs behave the same. So understanding cost behavior will really help us in terms of being able to predict future costs, being able to prepare budgets, being able to basically make pricing decisions. How much should we price our products, and also be able to calculate our break even so that we know how much do we need to produce to start making a profit. So understanding cost behavior is really important because we can make better management decisions. So what is cost behavior? So cost behavior basically describes how a cost changes when activity levels change, right? So it's basically the relationship between the cost and the activity level, right? For example, if we produce more units, does the cost stay the same or does it change, right? If we sell more units, does the cost stay the same or does it change, right? If we use more machine hours, does the cost stay the same or change? If we use more labor hours, does the cost stay the same or change? So basically is that relationship between cost and activity levels. So that's cost behavior. How does cost react to a change in activity? So there are 6 main cost behaviors, right? However, the first 4 are the ones that are the most important that you must know, right, for management accounting at the university level. If you really understand the first 4, you will never go wrong. And the last 2 you must understand at the high level, but the first 4 are really key for you to be able to do well in your tests and assessments if you're in university. So firstly, we have variable cost, fixed cost, step fixed cost, mixed cost, and then we have step variable cost and kev linear cost, right? So we're going to break them down in the next coming slides. So let's start with variable cost. So variable cost, in essence, the idea is the total cost increases in direct proportion as activity increases. So I'm gonna break it down to you. What this basically means with variable cost is they change in direct proportion with the level of activity. So when activity level increases, the total cost will also directly in proportion increase when you're speaking about variable cost. So the idea is if we produce 0, so this is activity, and this is the total cost. So what we're saying is if we produce 0 units, meaning that the activity is 0, the cost will also be 0. We won't incur any cost in terms of variable cost. However, the higher we go in terms of activity increasing, the cost will also increase, as we can see here. As activity increases, cost also increases. So that's the idea of variable cost. And an example is usually direct material. So if you go back to our example of a company that produces furniture, if you want to produce more tables, you will need more wood, and that wood will cost you more money. So there's a direct proportion or relationship between the activity level and the cost. So for example, if the cost per unit is 10 rand, when we produce 10 units, we'll need 100 rand because the cost changes in direct proportion with the activity. When we need 20 units, when we want to produce 20 units, then will need 200 rands in terms of cost, right? And that's basically variable cost. And when we're speaking about fixed cost, we're basically speaking about the idea that the costs are fixed regardless of the activity level. So they don't change based on activity level, meaning that as much as this is activity, this is cost. As much as activity is increasing, but the cost is staying the same, let's say it's 50,000 here, the cost will stay the same regardless of what activity we're sitting at. Whether we produce 10, we produce 20, we produce 30, it really doesn't matter. The cost will stay the same at 50,000. So an example of this is rent, right? So if you rent a certain factory, let's say you rent a certain building and you run it as a factory, whether you produce 100,000 units, 50 units, it really doesn't matter. The landlord wants their rent, which is 50,000 at the end of the month. So whether you produce 1 unit, 10,000 units, it really doesn't matter. The cost is fixed. So that's the idea of fixed cost, is whether you produce zero or regardless of how many you produce, you still have to pay the same amount. And then we move on to step fixed cost. So step fixed cost basically an idea that this cost, they change, they fixed in nature, but once it goes outside of a certain range, then it changes. For example, I said storeroom rental. Let's say you basically rent out a storeroom, right? And we're saying that that storeroom, you pay, let's say, let me make an example, you pay 50,000 for a storeroom. And this storeroom can only store, let's say, can only store 50 boxes. Just making an example. So you renting out this storeroom, it can only store 50 boxes and you have to pay 50,000. If you go above 50 boxes, you need a new storeroom, which you can also, additional storeroom, which you can also rent out at 50,000 to, for any boxes that are above 50 boxes. So the idea here is, let me just say 50K. And I'll just put a line here. No, I need to put it like this. So the idea is, as long as these are the boxes, in this case, which is the activity. So the activity are boxes that you store. So the idea here is, as long as your boxes are still below 50, you're paying 50,000. However, once you go above 50, now you need to pay 100,000. Why? Because you need more storage, right? You need more room. So you need to rent out this additional storage. So the idea between fixed cost is basically this idea that they fixed for a certain range, but once you go above a certain range, then they change, right? So you can see here that they fixed for this range, but once you go above 50, it jumps to here. Once you go above 100, it jumps to here. So that's the idea behind step fixed cost. And then we have mixed cost, really important to understand as well. So a mixed cost is basically a cost that contains both the fixed component and the variable component, right? So I'm going to make an example with an electricity bill. Let's say in your area, basically ESCOM or whichever electricity provider, they charge you a certain monthly fixed amount to be connected to the grid, right? Let's say they charge you, I'll just say they charge you 1,000 rand. So they charge you a fixed 1,000 rand to be connected to the grid, just to be connected to the grid. So whether you use electricity for that month or you don't use electricity for that month, as long as you're connected to the grid, you have to pay 1,000 rand. Right? So that's a fixed cost. That's the fixed component of the cost. However, on top of that fixed monthly charge, they also charge you a cost per kilowatt used, right? So the more electricity you use, there's a specific cost per kilowatt that you pay. So there's a variable component to it. To say as activity, as the kilowatts, this is activity. So in terms of kilowatts. So if you produce zero, you pay that fixed 1,000 rand to be connected to the grid. But once you produce more, once you start producing more, the cost goes up because you need to pay this variable component, which is the cost per kilowatt. So that's the idea of mixed cost, to say they have a fixed component and a variable component. And then the last two, which you just need to understand at the high level, but the first four were really the most important ones, is so we have a step variable cost. So step variable cost, you can think of it the same way as the step fixed cost. I mean, it's more of like a staircase. It's more of like a staircase. I know I didn't draw it right, but that's the idea, that it's more like a staircase, because it's step variable, right? It's more like a step case. And then you have a caviar nonlinear cost. So a caviar nonlinear cost is costs that are weird. So these two costs are really weird costs that we don't see that much. So a caveat is when, like, let's say, for example, you have to incur a lot of cost in the beginning because you're doing some research and stuff like that, but you reach a certain point whereby the cost drop because you've done the research. Now you understand how to be more efficient, and they drop. However, you also reach a point whereby beyond a certain capacity, it becomes more costly now to produce more. Therefore, the cost changes up. So it's like curve linear in a way, right? So these two costs, really, they're unfamiliar in management accounting, and you can get away with understanding them at a high level. But the first four, which is your variable cost, fixed cost, step fixed cost, and mixed cost, are really important for you to understand. And lastly, why is this foundational? Why is this important for management accounting, right? So management accounting builds from this, right? You need to understand how cost behaves, because once you understand how cost behave, you can do your CVP analysis to calculate break even. How much should I produce in order to cover all my costs? Basically, this topic is foundational, because once you understand it, you can do costing better, you can do budgeting better, you can do standard costing, you can make better decisions. So this is really important. I can emphasize this more. So thank you for watching. If you need more support from us, you can check the description of this video, and we'll be happy to assist you, helping you genius up in accounting.